What's going on, guys? Welcome back to another video. In this video, I've got another very important AMC update to bring all of you this afternoon. So what we're going to be covering in this update is a little bit of the Ortex short interest and utilization data for those of you guys who have not seen it yet. And there's kind of an interesting thing that I want to point out to you guys on this data, but then we're going to move into two very, very important concepts. Now, next week, the option chain is absolutely insane. It does have a lot of potential for somewhat of a gamma squeeze if we start to see that buying pressure start to move in the right direction. I'm going to show you guys the key levels that we really honestly need to break through in order to really put the pressure on these market makers and even the shorts. So then moving off of that, we're also going to be talking about some of these hedge funds that are getting liquidated. They're getting vaporized and taking very, very significant losses. Now, these hedge funds are supposed to be the quote unquote smartest guys in the room. And throughout this past year and more recently, we have almost seen the most amount of hedge fund closures that I have ever seen in the past. So obviously there is a problem with the way that their investment strategies are working. And I really think it comes down to one of the things that we talk about on the stream all the time is that fundamental value. If these funds are trying to invest based on fundamental value, it is just an opinion and an estimate based on the numbers provided to you. But at the end of the day, the market is going to be able to be the only deciding factor at what something is worth. So before we get into all of that information, if you enjoyed the information and analysis that I provide for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So when we're moving over to the Ortex data over here, we can see utilization 75.34%. If you guys want an in-depth analysis of the utilization and cost to borrow, make sure you go watch my previous video where we point out exactly what's going on with the trends in these numbers. But a lot of people have been pretty nervous about what the price has been doing on AMC recently. Now, we have also started to see the short interest start to climb up. What that tells us is that, yeah, the shorts have not covered. This situation is still not far from over. But when we see more shares starting to go out on loan and less buyers coming in to counteract those new short sales, yeah, we are going to see the price of the stock start to fall. Now, that doesn't necessarily mean that the shorts are right. It's just there's not enough pressure from the other side coming in, and that would be the buying side. But again, 19.26% estimated short interest is very, very high. So again, the apes are not leaving. In my opinion, I have not seen any signs that are telling me that any of these situations, GameStop, AMC, any of these other big short squeeze stocks are anywhere close to being over. Now, I want to get into this situation with the potential gamma squeeze coming up for this next week. Now, nothing is guaranteed. There are going to be weeks that have higher potential than others, and this week coming up, the January options expiration date does have a lot of potential, and you guys have heard my thoughts on this many, many times. But here are some new things that we need to take a look at over here. So when we come over to the max PAYNE chart, well, we actually saw the max PAYNE step up from 22 from this date right here, this next week expiration, to all the way up to 23. So it's a $1 increase, nothing too crazy, but here's kind of what's important about this. Remember, in my opinion, I don't think a lot of these market makers are hedging these options because they don't necessarily have to. We've gone over this in the past, but if they are able to finish us below max PAYNE every single week, decrease the deltas of the calls, increase the deltas of the puts, it kind of balances out and they can maintain that directionally neutral status without even going out into the open market and buying shares to hedge the options that they are selling. But here are some key levels that we need to look out for. And coming down to this chart right here, I think it gives us a really good understanding of what are some of the key price levels that we need to get to. So the kind of yellow line right here, yellow beige line, that's what we're going to call it, I guess, is going to be the calls. And the red line over here is going to be the puts. And you can see that on the y-axis over here, this is going to be the open interest. So when you look at what's going on over here, the puts are outweighing the calls in open interest until we get to that $23 price point. When the puts are higher than the calls in terms of open interest, Well, that means that if the market makers are hedging, they're going to be shorting more shares into the open market just to hedge the options that they are selling. But when we start to break 23, we don't see another time where the puts are going to be outweighing the calls. So that's kind of why we've been seeing that fight for 23. We saw it 2 weeks ago with that nonsense 22.99 finish. And we've kind of seen us really struggle to get over that $23 price point. So this kind of brings us to the concept of danger zones. So we've gone over this in the past, and we've used average days on loan to kind of cover this. And the way we look at it there is kind of the danger zone for the actual shorts, not the market makers. But it looks like right here, 23 being max pain, it is a little bit of a danger zone for these market makers, because after that, well, there's going to be an imbalance shift in terms of their net position that they're going to need to have in terms of the hedging. Now, if we continue to go up after that $23 price point, well, there's going to be more and more calls. We hit 30. That's a really big point right there. And then the danger zone that we saw for these shorts in the upper 30s, low 40s, well, there's a lot of options exposure right around here. Now, again, nothing's guaranteed. Just because the option chain is looking like this doesn't mean that we have to skyrocket. We're going to need to see that extra buying pressure coming in. Now, again, we are most likely going to start to see a lot of people buying at the money calls this week. Now, a lot of people have been educating themselves to kind of figure out what is the likelihood of these contracts running in the money and what effect is this going to have on the market maker. Now, it's not my position, and I don't have enough control, nor do I want to come out and tell people what they should be buying. But typically, we are going to see some effects like this happen right as we start to get into that weekly options expiration, because there's less time to expiration, and we are going to see people being able to afford these in the money or at the money contracts going into the end of this week. So we're going to have to watch out for that. It's kind of up in the air right now. We know a lot of people are going to be gambling on these options. So we're really going to have to wait and see how it plays out. We have 87,000 call contracts in the money right now and 114,000 put contracts in the money. But the calls, there's 630,000 contracts out of the money. That provides a lot of potential. Now, let's get into something that's been going on with these hedge funds for some time that is really putting a lot of pressure on them in terms of the overall over leveraging that they've basically put themselves through over the last 2 years. Now, moving over to the FINRA website, we're going to be taking a look at the margin debt over here. So we've previously looked at this this data on that chart from advisor perspectives, but I think this gives us a little bit of a deeper understanding. So this is going to be shown in millions. So every number that you're looking at here is going to be 798 billion, 813 billion, 822 billion. So those are the numbers that we're looking at. So over the last couple of months, from September into October, we saw the margin debt start to step up, getting closer to $1 trillion of margin exposure. Now, recently, the numbers have recently come out from the October to November numbers, and we've seen this significantly decrease. Why is that? Well, a lot of these funds have taken out a lot of leverage in the way of margin over the last 2 years, meaning they're essentially getting loans from their prime brokers or any other broker that they're using in order to lever up their returns. Now, here's the thing about margin. It's awesome when the position is going in your direction, but it's equally as bad when the stock or whatever you're trading is going against you. It's going to amplify your returns, and it is also going to amplify your losses. So there's about 20 billion of margin debt that is basically evaporated from October into November. Now, remember, December was pretty choppy. We did see a lot of volatility in December. We weren't really seeing that Santa rally that we were expecting. And even January, we are seeing a lot of volatility too. Now, here's something that I want to point out to you guys. Remember, we were seeing some hedge fund closures come out in the beginning of December. Now, we saw Anchorage right here, who closed their flagship $7.4 billion fund. And we are also seeing this fund over here out in Sweden. Hedge fund veteran Broomer looks to hire new traders after record loss. Now, they did only lose about 0.4% in 2021. This is probably one of their funds, their flagship fund. But again, as you see over here, they closed a decent amount of their funds as well. Let me see if I can find it in this article. I believe they closed about 7 of their other funds as well. So, just kidding. Over here, investors nursing losses this year will be hoping he's right about turning things around. In recent months, the firm has been hit with 2 fund closures. So they are closing down 2 of their funds. They're taking significant losses because they're over leveraging themselves on their bets. Now, what does this mean for us? Well, this isn't necessarily directly related to AMC and GME, unlike unless these funds also have bets on those stocks as well. Now, when we've looked at the price action of AMC and GameStop over the last couple of weeks, if you're short on it, you are making a decent amount of money. But in my opinion, I don't think that is going to last for very long. We are seeing, if you guys saw the video last night, a lot of data starting to really turn in retail investors' direction and starting to put the pressure, or getting to the beginning stages of really starting to put the pressure on the institutions that are taking out loans against of stock against AMC and GME. So that is mainly going to wrap up this update on AMC. If you enjoyed the information and analysis that I provided for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So I hope you guys are having a great long weekend, and I'll see you guys in the next video.